Typically, people put 20% down on a down payment for a house. You can actually put down much less and even roll the cost of the rehab into the loan. That's the topic for today's video. Let's dive in. Hey, what's up? I'm Mark Bellini, and I'm all about achieving financial independence through real estate investing and online business. So if you're interested in achieving financial freedom for yourself, be sure to like and subscribe and you will not miss a thing. So when you're looking to purchase a home, there's a few ways to go about financing the property, and we're going to go over two of the top ways. And one is a conventional loan and one's an FHA loan, and we'll kind of go over the two and which one might work best for you. So a conventional loan is what most people hear about. It's 20% down of the purchase of the house. But actually, against what most people think, you can pay a lot less with a conventional loan. You can pay whatever you want down to about 3%. So you can pay, 20, 10%, 15%, 5%, or 3%, whatever you kind of want. The only thing you have to do at that point, if it's less than 20%, you have to pay something called PMI, and that's for private mortgage insurance. And what that is it basically insures the lender against you defaulting on the loan. And you pay that until you reach 20% equity in the property, and then that fee drops off and you don't pay it anymore. So that is conventional financing. And the thing is you need to have, if you're going to pay less, if you pay down to if you're paying like a 3% down payment, you're going to have certain credits and income requirements to qualify. So that's something you'll have to look into. The other option is an FHA loan, and that is a loan backed by the federal government. And FHA stands for Federal Housing Administration. And they were founded in 1934, and they basically help people kind of get into their first home. And how they're different is, and I got some notes here. The requirements in 2022 is you need to have at least a 580 credit score, 580 or above. And not all lenders will accept 580, but that's kind of like the bare minimum, and you can probably find a lender that will work with you at that point. Your debt to income ratio needs to be less than 43%. This also needs to be your primary residence. You need to actually live in the property for at least a year to qualify for this loan. Also, similar to private mortgage insurance that you pay on a conventional loan, a FHA loan has something called MIP, which is mortgage insurance premium. It's basically the same thing, but it's just a different, they call it something different, but it's the same idea. It's insurance in case you default on the loan. But the difference is with an FHA loan, that fee actually never drops off. You pay it for the entire life of the loan. So that's something to keep in mind. So if you want to remove that fee at some point in the future, you actually need to refinance. Probably once you have 20% equity in the property, you can refinance and then get rid of that fee and lower your payments, assuming the interest rate is relatively the same or lower. You also need a steady income with proof of employment and the basics. But what's interesting about FHA loans is actually they will work with you if you have like a bankruptcy or something in your past. They actually will be more willing to work with you to get you into a house. So if you have that, that is something to look into as well. Now, as an example here, let's say you want to purchase a property and it's dated, it's really old, but you can't afford anything really nice, and so you're going to buy something older, a little dated, but still functional. There's not holes in the walls or broken windows or anything like that. It's just older. You can actually get something called a 203K rehab mortgage insurance, and what this does is you can, let's say you purchase a home, you can buy the house at a certain price, and then you can work with contractors to see what the rehab is going to take on the property, and you can roll that into the loan and then pay 3.5% of that total. And then basically when you purchase everything, you'll have financing to do the rehab, complete rehab of the house, and then you'll have a nice, fixed up house at that point. So that's an excellent way to kind of build some equity into your house. So these are two great ways to get into real estate. If you have not started investing in real estate, this is an excellent way to get your foot in the door and just get started. I bought my first house with, I think, 13% down, and the house that I'm in now, I think I put down 10%. So just get in, get started, and hold for the long term, and you're going to be just fine. So if you enjoyed this content, be sure to like and subscribe, and I'll see you in the next video.